Welcome to this week's market drama. We'll begin with the S&P 500, which was up 50 basis points, 0.5%. NASDAQ was up even more, 1.6%. Year to date is now up 28%. Now, keep in mind that we did have a couple of weeks in a row of negative stock market performance, so we were, to a certain degree, due for a bounce. But the big story was actually the 10-year Treasury bond market. The yield continued to rise. It was up 0.2% to 4.79, which is a yield level we had not seen since 2007. So what's going on, right? What economic data can we point to this? Well, we actually had the September employment report come out, and payroll gains came in at 336,000, was significantly higher than consensus expected, and the unemployment rate held steady at 3.8%. Equally important, we also had an average hourly earnings come in at 4.15 year-over-year growth. That is now the fourth consecutive month, and we've seen this wage growth number come down. That is a big positive development, right? That the Fed is going to keep an eye on, because wage growth and inflation are closely tied, right? So if that wage growth continues to come down, if core inflation continues to come down, that over time might give the confidence, right, to start lowering interest rates next year. Nonetheless, the stock market's a bit confused. The bond market's a bit confused with this good economic data, inflation still higher than usual, but coming down, right? So that's really kind of what's driving markets right now. To give you a rule of thumb when it comes to the 10-year Treasury yield that's been used now for well over 70 years, is there is a relationship between nominal GDP growth and the 10-year Treasury yield. Essentially, the long-term bonds are trying to give you a proxy for inflation plus real economic growth, which is nominal GDP growth. If you think about core inflation, let's say even at 3%, which is higher than we've seen in the past. If you look at real GDP growth, even lower than we've seen in the past, the last decade was around 2.3%. So let's make it 2%. That's 5% nominal GDP growth. So looking at a 10-year yield of 4.79, it's actually not crazy to see those type of levels. You got to remember that for the last 25 years, the Federal Reserve kept interest rates extremely low in the short-term rates, and they were buying long-term bonds and, in essence, suppressing yields on the long end of the curve as well. So yeah, now that they're not kind of leaning into those long-term bonds by not buying a lot of the bonds they were buying in the past, kind of letting them roll over off their balance sheet, it's not crazy to think that we're at 10-year Treasury yield at 4.79. Now, where it goes from here, we're going to have to keep a close eye on the data. We do have CPI and PPI data next week, which will give us another data point for where inflation is now, and therefore what the Fed might want to do when it comes to interest rates in the coming quarters. That's it for this week. Stay tuned for the next week.